Hey folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update is for Monday, August 24th through Friday, August 28th, 2009. Well, folks, as we get into this weekend technical analysis update for next week, I really want to focus on some key things. I want to look back at last week, see what happened last week, and how big of a deal it was. The fact that we had that monster sell down Monday, really the biggest down day in almost 2 months, and then ultimately Wednesday, Tuesday, Wednesday, Thursday, Friday, you recaptured that whole loss and then even pushed higher than the highs of this market, closing at a new high for the year. Now, that's very significant because you really closed above 9,500 on the Dow. That was very significant, and you took out the old highs of 1018 on the S&P, which were also very significant, closing at around 1025. Just for Friday alone, the Dow was up 156 points, Nasdaq up 31 and a half, and the S&P 500 was up 18.75, almost 19 points, closing at around 1026 for the week. Now, the real key for last week really came in the form of Monday's action. I'm going to go back to Monday's action, then we're going to talk about the technicals. But really, here's last Friday, a week ago from Friday, where you had that sell day, but you really basically were down 150 points here, and you rallied all the way back to cut it in half down to 75 on the Dow. Now, that was pretty significant because we saw, again, the buy programs hitting this market. Buy programs we've seen over and over again. I'd probably say about 8 out of every 10 days there's a buy program that comes in this market over the last 5-6 months in this, which is amazing. I mean, just think about that money flow that's coming back in the market. And part of that, I think, is, I do think at certain points you have, like, the propping going on, the PPT, but I think part of it is also you have multi-short squeezes. When the market doesn't fall any lower throughout the day, a lot of shorts cover by the end. That causes some little buying coming in the market. In addition, I think what you have is mutual funds. Remember, these money managers, folks, have situations where they have to put this money to work. They've been sitting on cash and the markets are now up 50%. Now, there's two ways of looking at that. One is if they don't put money to work, they're going to lose the money because people are going to pull it out from them and give it to someone else who did use the money or will use the money. So there's a no-win situation for them there because they don't even make their basic fee, which is 2% or whatever they're charging on the bottom line there. Next is what if they put the money to work right now in the market when the market's up 50%? Yes, they could lose and they're fully aware of that, but at least they're getting their fee. So either way, they could lose the money because the person, if they lose money, is going to pull out their money from them. But if it's not utilized, they're going to pull it out anyways. They might as well make their fee. And I think you're seeing that. Smart money definitely at this point should not be putting money to work in the markets at these heights. I think a lot of the amateurs are putting it together. A lot of these mutual fund managers, which by the way are right along the worst of everyone. When it comes down to it, they're just about as bad as the individual investor, which is on the wrong side of the curve. But there's more of a pressure there. The individual investor thinks everything's clear and good because the media is telling them, Obama's telling them, Geithner, Bernanke saying everything's good, while the mutual fund is more motivated by the fact that, listen, I got to put this money to work so at least I make a fee off of it and can pay bills regardless of what happens to the money. All right, it's a little more like a broker in that situation about the negativity of it, where you see some of the downside of having money managers that need to put money to work. All right, bottom line is, regardless of what's going on, you've seen the market rally from Monday's big down day right down here where the market really got crushed, and it was interesting because you didn't even have a buy program here in the day. You basically gapped down, pushed down to the lows right around that 98 level and traded sideways, and they actually closed just near the lows of the day. Interesting thing about this is Tuesday we started to bounce, minor bounce day, and then Wednesday we had another gap down off Asia weakness. China got smoked again, a lot of Asia got hammered, and the markets gapped down. But the interesting thing about it is, folks, is that Asia gapped down to really a double bottom down here. Check it out. If you rotate back to the lows on Monday, look at where the low of that candle is right there, right into the low. So you really had a double bottom situation there on the SPY where we were at a double bottom. So 98 all of a sudden becomes a very, very firm line in the sand based on the fact that off of that gap down, you just started to rally. And what a rally it was off those lows, folks. Look at this. Big buy program hit. Sideways consolidate. This is bullish. Again, know your patterns. Remember, price, pattern, and time. So bullish blast off, bullish consolidation, which is sideways, slightly lower consolidation off a big move. Sure enough, that yields to another pop. Also, note where it pops. It pops right where the 20 and the 50 converge right there. That's like lighting a fuse to a bomb. It goes off. Boom. Blasts off right there. and then you really sell off a little bit into the close like that, and that's the way Wednesday was. So again, Tuesday, Wednesday up, Thursday comes in, we start to rally even more so, and have another update where you really rally right at the start of the day, push up to about 10:30 in the morning, and then you trade sideways for 3/4 of the day, and then a little bit of a push and pull back into the close. Interestingly enough, the same pattern repeated again on Friday. The only difference with Friday is it was a bigger update than Thursday. So Friday here, look at the pattern. Up move early until 10:30, sideways till about 3 o'clock, and then pop and minor pullback. So again, what happens on Friday, big pop early, sideways till about 3 o'clock, pop and pull back like that. Look at the pattern, same pattern, up, sideways, up, and small pullback, up, sideways, up, and small pullback. So the same pattern repeating itself here that we have to watch out for. And the key about Friday really is we had a high on the markets. Really, again, I mentioned that 1018 level on the S&P. The SPY, for those of you that follow that, since that's what we're looking at here, was 102.03. That was the previous high going back about 3 weeks ago or so in this market, 3 weeks ago. Sure enough, Friday took that high out. Here's the former high. This line right here in pink, that's the former high of this market. So we actually hit it on the first candle pullback, hit it again, and then finally closed on it and then blasted through it early in the morning. Once you took that out, that was a very bullish sign. When they can take out the high pivot of this market that easily on an intraday basis, that's a very bullish sign for the rest of the day. And sure enough, it basically meant you were going to trade pretty much positive and up for the rest of the day. Higher, we went higher from that level to about 103, traded sideways, went to test 103 again, and then pulled back. All right, so there you can see the same pattern played out from Thursday, but again, a good solid move on the markets, and they took out that high. Now, what does that mean? Does that mean we're going to continue to go up even higher? Well, it could, and there's some key things that you need to be watching for here. First of all, the volume in this market over the next 2 weeks is going to be key. This next week in August is sometimes the lightest week of the year. Also, after that, you have the week prior to Labor Day holiday weekend. So you're going to see a lot of the traders take these last couple weeks off to go on vacation. So watch for that. See if the volume is light. If the volume is light, you always give the market a sideways to upside bias, all right? That's just general rule. We talked about that to you guys time after time. So you want to be aware of that. However, what you have to also keep in mind is that there are some key things converging now. There's a lot of cycle activity converging over the next 2 weeks that you have to really be aware of. And we talked to our premium guys about this more so. And again, I can't reveal much more than that, but it's something you really, really need to be aware of as a trader or an investor because of what's going on here. So again, you have a couple, converging issues here. First of all, the light volume, late August, early September. That's going to be the way it is. Once we get to mid-September, volume will pick up and be very, very powerful again, and probably go back to where it was in before the summer started. But the other issue again is the matter of the cycle activity stuff that's going on. And again, we're talking to our research center guys, alerting them to anything we see. Now there are some key levels above this 103 level you need to be aware of. One level you'll watch for on Monday. I'm not going to go into the ones higher because again, that's for our premium guys. But right here you can see on this level right here, 103.15. 103.15 come Monday is going to be an important level. Then you can see these blue trend lines. These blue trend lines are very, very significant. Look at how both of these came through, and these are through major points in the market. Both of them gave us the bottom before the little bit of a pop late in the day. Those are big, both of them right here. If we can get below that, you actually should come all the way down and test the 102.50 level. 102.50 big level. You can see here it touched it and then bounced off of it, and then another tail right here before we bounced up to new highs. Both of those levels that on that 102.50, both of those candle touching that 102.50, that was a major level we were watching all day intraday on Friday and needs to be continued to be watched. On the downside, below that, if you break through the 50 moving average and this secondary blue line will come into play, after that you're going to have a very important level at 102. Why is 102 important? Because that was the high until it was broken on Friday. That was the resistance high. Once that gets taken out on the downside, it becomes support. Broken resistance becomes support on the downside, and vice versa. Support and resistance become the opposite when the market breaks through them. All right. After that, you're going to look for a little bit of a minor level right here, which is going to be gap fill. I'm just going to draw that in for you guys right now. That's at 101.65, 101.50, right in that area. And after that, if you come down, you're going to have the high pivot from Thursday at 101.25, and then ultimately at 101 down here, which would be official gap fill on the charts on the downside. Below that, you have a good little level there to drop all the way down to about 100 spot 30, and following that, the 200 moving average for next week. But this is really what you're looking for. Again, you're looking to see, does the volume be a bigger level here, or does the cycle work be bigger? Which one's going to be the key for next couple weeks? Right now, the longs, the bulls have been winning this market flat out. Bernanke came out on Friday and pumped his chest hard. He said, "I've been right. I've done the job. We're on the cusp of recovery here. Rah rah rah." My theory on that is he's pumping the market, make sure it stays as positive as possible, and Obama is waiting in the wings. If he fails, guess who's the fall guys is going to be? It's not going to be Obama. It's going to be Bernanke, and he just won't be reappointed next year, and they'll have Summers come right in. That will be a timestamp. Remember that call, guys. That, I think, will ultimately happen. I don't see Bernanke getting reappointed because I don't think the economy is going to show enough improvement over the next 3-4 months to get him reappointed. I think it's going to look like a rah-rah speech here. In fact, it wouldn't even be surprising to me if that rah-rah speech calls actually the top on this market. But we'll see next week. Again, light volume could be a big, big catalyst either way in this market based on what the cycles show us. Now, let's go to the 60-minute chart. These are your main levels on the 60. You can still see that 103.15 level. Below that, you have the 102 spot 50 level. Below that, a major level coming right in here at 101.65-ish that I called out. Below that, 101.30, and then the 20 moving average. Right below that, 100 spot 75, 50 moving average. 99.90 to 100, and then ultimately down to 99.50 down here. If you got back to this double bottom at 98, that would be impressive support for this market in the remainder of the next couple weeks. Very, very impressive support down here. If that broke, 97 would be next. But nonetheless, on the upside, if you get through 103.15, you can look for actually a push to 103.50, and then 104 would be the next spot of resistance on the charts. Scalping, definitely a possibility. Overall, folks, what I have